we're seeing things on the back foot here when it comes to risk assets as we kick things off. It seems like the third quarter woes are still very much there. What do you think the rest of the year is going to look like, and what sort of catalysts are you looking out for?
Well, I think the correction is not unwelcome. A lot of our clients are still sitting on disproportionate amounts of cash. So we think it's a window of opportunity for our clients to deploy. So we've been telling clients, there are three asset classes out there, cash, bonds, and equities. Why are you staying in the most expensive asset class, i.e. cash? So I think it's a great time to be involved. And we've been telling clients, do it on a portfolio approach, the barbell approach that we have been talking for quite a while.
Okay, but let's just narrow in on what's happening stocks-wise. And you're suggesting at the moment that we're going to have a loss of growth momentum, perhaps, here as well, and that would result in equity market returns also moderating here too. But, how often do equity markets and investors actually look at the fundamentals? Yeah,
the fundamentals are not negative. I mean, US, Europe economies are reopening, and that's going to be pretty good for earnings to sustain the strong earnings that we have had. But really, the world that we are in now is really changing so very fast. We have to be extremely selective in terms of companies, in terms of sectors, which is why we think the big winners are the innovators, the disruptors, the enablers, adapters. We call that under the acronym IDEA. So that is really the part of the portfolio that we would advocate that clients are invested in for capital growth. On the other end of the barbell portfolio, because rates are going to stay low, you got to buy into income generating assets, and dividend yielding stocks is probably the new bond proxy. Asian high yield, I think, makes a lot of sense. Excluding the distressed credits like the Evergrandes, we're still getting about 6.5, because of the recent sell-off in high yield.
Okay, so yeah, when you have stocks as the new bond proxies, yeah, you got to look elsewhere in the high yield. Wait, I was going to ask you about the outperformance that we have seen in DM. And it's really in terms of the stark contrast we're seeing against EM. You guys have talked about how usually when the Fed starts the tightening cycle, EM does usually underperform. Is this time basically the same, you think?
Yeah, so historically, whenever the Fed tightens monetary policy, so in this case, they'll be tapering. Developed markets normally would outperform emerging markets. On top of that, I think looking at the COVID spread and all that, the vaccinations, we are still some ways in terms of catching up with the developed world. So I think on that basis, we would be at least for fourth quarter overweight US, Europe vis-a-vis Asia and EM.
I was just looking at, your pivot towards tech again here, and it's very interesting that you point out several reasons why, including government spending. We've got also people indulging in more capex now, not doing the share buybacks that they've done to artificially inflate their EPS. Now, tell me something here, industrial automation, AI, that sort of thing as well, health tech too, very much at the fore. Give us a sense of where this all goes.
Yeah, so the pandemic really kind of exposed, many countries to the vulnerabilities, towards the global supply chain. And really the trade war between China and US is not how much I export and import with you. It's really about who has the edge over technology. So I think the race towards self-sufficiency has started. And the beneficiaries of that would be semiconductor companies. Everyone is investing in factories. Come TSMC, come Samsung, and build factories in my town. In my country. So I think that is another kind of a catalyst or tailwind for the technology sector.
Is China Tech part of that story too? I'm just talking about when it comes to HS Tech, we continue to see, we're off some of the 44% from the peaks that we saw in February. Are you seeing much upside now?
Yeah, I think, the regulatory changes in China has created, a sell-off, and big names like in China have fallen like 50%. Until we see more clarity, I think we will, kind of withstand or not be tempted to buy more at this stage. But really, you still need to be engaged in China. The long-term fundamentals, no one can argue. They're still growing 5 to 6% every year for quite a considerable period of time. But how do you express that in the meantime is through Shanghai A shares, as well as China banks. We think, really China banks sit very nicely in our income generation part of the barbell portfolio, giving you a yield of about 6%, very sustainable because the payout ratio is only 30%, compared to, say, regional or global banks in excess of 50% payout ratios.
Perfect. Last question from me anyway. But surely the biggest risk there is the next regulatory shoe to drop, and that must make you wary.
Yeah, so we got to be selective. Like, for example, in China, I don't think the large banks will be impacted by regulatory changes. In fact, so far insulated. But we also kind of look at the valuations of these tech companies in China, and really, they are trading at very reasonable growth at, reasonable price kind of valuations, gap. So there is, I would say, a margin of safety. But again, whenever there is an overhang, in terms of uncertainty, the prices cannot go up for now. But really, we are sitting on very nice levels of margin of safety at this point in time.